All right, so I'm going to solve this question. I'm showing you my methodology. And so we're going to start by reading the question. Prepare a partial statement of cash flows, operating activities, a statement of income from Neil Transport, Inc. for the year ended December 31st, 2023, reported on the following condensed information. We've got the statement of income here, and then we've got some of the information from the statement of financial position. Additional information, operating expenses include $70,000 in depreciation expense. The company follows IFRS, assumes that interest is treated as an operating activity for purposes of the statement of cash flows. And then it says, prepare the operating activities section of the statement of cash flows for the year ended December 31st, 2023, using the indirect method and using the direct method. Okay. And then part B we'll do in a second. So step one is to apply the formula. And we know for debit accounts, it is prior minus current. And for credit accounts, it is current minus prior. All right. And we never apply to cash or retained earnings. So in this case, this is the information: accounts receivable, prepaid insurance. So I'm going to quickly type these out here. There we go. And I'm just going to do the difference. Remember, if it's a debit account, I'm going to do prior minus current. I've got to be careful that I know that this is the prior year, right? Because it could be flipped. So this is the prior year. So for all my debit accounts, I'm going to do this. So that's prepaid insurance, a debit account. Accounts payable is a credit account. So I'm going to take current minus prior. Then interest payable, same. Income tax payable, same. And then unearned revenue, same. There we go. So now I've got all of the differences in the statement of financial position, balance sheet, accounts. So I'm going to move on to step two. And then step two is do a retained earnings proof. So this is not applicable here because they're only asking us to do the statement of cash flows, operating activities. And of course, the retained earnings proof is for the financing activities, the dividends paid. Step three is T account proofs. Well, again, this is not applicable because we're not going to do anything having to do with either financing or investing. T account proofs generally involve those two. Okay, so step four is to classify into the three activities. And so we've got O is equal to operating, I is equal to investing, investing, and F is equal to financing. Now, in this case, I happen to know that these are all operating, but it's still good to go through these steps so that you know exactly what's going on. And of course, step five is to create the statement of cash flows. So I'm going to do that here. So in this case, I'm going to and then it's for the year ended December 31st, 2023. Okay, I'm going to start with cash flows from operating activities. Now, remember it says to use the indirect method first, so I'm going to start with net income. And my net income comes directly from here, so you can see not comprehensive income, net income. And it comes from right here, 148,000. Then I'm going to do all the changes. So generally they have something that's called adjustments to reconcile net income to net cash. Here we go. We're going to start with the accounts receivable. And again, I'm going to take it with just the number that I've got. And I know all of these are operating. Prepaid insurance, I'm going to do this. I'm going to do the accounts payable. Actually, I can just pull it down. There we go. And I can do the same here. Now, one additional thing that we need is we need depreciation, because depreciation is on the income statement, but it's a non-cash item. And they show us that depreciation is $70,000. So I'm going to put depreciation expense, and I'm going to do a positive $70,000. Why? Because depreciation included in net income is an expense, a negative amount, and I want to eliminate it because it has nothing to do with cash. So in order to eliminate it, I put a positive against it. Now, anything else that I have to do? I have to look for other non-cash items. And other non-cash items, I'm going to put a little note here, include gains or losses on the sale of long-lived assets. So this is things like property, plant, and equipment, intangibles. If we sell them, there could be a gain or a loss, and that's an accounting gain or loss, not a cash gain or loss. So I go up here and I look at this income from operation, other revenue. Gain on disposal of equipment is $25,000. So here I'm going to do the gain on disposal of equipment, and it says it's $25,000. This is a gain, it's a revenue, it's non-cash. So I have to eliminate it. I'm going to put a negative $25,000 against it. Negative 25, 1, 2, 3. There we go. So now I'm going to have the total of all of these. So let's do the auto sum. There we go. Total of all of these is 41,750. I'm now going to underline this, and I'm going to put net cash provided used by operating activities. There we go. And I'm going to take these two and add them together. Now notice that the net cash inflow from operating activities is positive, and it appears to be very healthy. It is above the net income, which speaks to the quality of the earnings that we have. So this is a good thing. We want positive cash inflow from operating activities, particularly if this is a mature company. So we did that. Now what we want to do is we want to do the same thing, but we want to use the direct method. So in the direct method, we take the income statement and remove all the subtotals. So over here, I'm going to do the calculations for the direct method. And I need the income statement, so I'm just going to put it over here. And I'm going to start with sales revenue, operating expenses, income from operations, we ignore, it's a subtotal. Then we do gain on disposal of equipment. We do the interest expense. We do the income tax expense. And then I'm going to put all the amounts here. Now remember, and I should put a little note here because I forgot, always indicate the expenses as negative numbers. That's really, really important, and I didn't do that here. Negative 370, 1, 2, 3. Gain is positive. Interest expense is negative, so that's negative 10,000. Income tax expense is negative 42,000. If I add this all up, it should end up being equal to net income, 148 it is. So now I know it's equal to net income. I can put this aside. Now, all of the adjustments we have here, we have to duplicate over here. So I'm going to take all of these adjustments and I'm going to put them in the correct place for the direct method. And I just want to be clear, this is the indirect method. And over here, we're going to do the direct method. And with the direct method, you always start with the income statement and make adjustments to the income statement. So over here, it says operating expenses include $70,000 of depreciation. That's all they say. They don't say anything else. So looking over here, I know I'm going to do adjustments. And I might do more adjustments. Okay, so accounts receivable impacts sales revenue because when accounts receivable goes up, then sales revenue goes up. So I'm going to put the positive 10. Notice I'm just holding the sign. The prepaid insurance is part of operating expenses. The accounts payable has got to be part of operating expenses because this is a service company, so that accounts payable is going to go in operating expenses. Interest payable is going to go against the interest expense. Income taxes payable goes against the income tax expense. Now, where does unearned revenue go? So unearned revenue goes against the revenue. Whenever you see unearned revenue, it's going to go against the revenue. Depreciation expense is included in the operating expenses, so I'm going to put the depreciation expense right here. The gain on disposal has a gain on disposal, so I'm going to put the gain on disposal right there. Okay, so I had one additional adjustments. There we go. So now I'm going to take the total. This is the cash received from customers. This is the cash paid to suppliers. This is nothing because, of course, this is now gone because it has nothing to do, right? I'm going to strike it out. Has nothing to do with cash at all. So then this is the cash paid for interest, and this is the cash paid for income taxes. If we add these up, this should equal to the 189,750. 189,750. So if I did do the cash flow, so just to be clear, if I had the cash flow using the direct method, everything would be the same. I would still have the cash flow from operating activities, but I would start with the cash received. There we go. And my amounts would be straight from here. And then I would have net cash provided or used from operating activities. I would do the total right over here. There we go. So notice it's only the operating activities that change from either the indirect method or the direct method. So let's look at the other question. It says, from the perspective of an external user of this company's financial statement, discuss the usefulness of the statement of cash flows prepared using either the indirect or the direct method. All right, so let's go back here for a second. Okay, and I'm going to bring this down so that we're comparing apples to apples right next door to each other. All right, so we see this is the indirect method. This, of course, is the direct method. And let's be honest, whether we are using the indirect method or the direct method, the fact is the statement of cash flows really tells the external users or allows the external users to assess this company's ability to generate cash through their operations, right? The only sustainable source of cash. And it really allows the users to compare the performance, right? The operating performance, which is the income statement, to the cash flows, right? Both year after year within one business, but also between different businesses in the same industry. The indirect method really focuses on the differences between net income and the cash flow from operating activities. So it actually shows you all the reasons why there is a change from accrual accounting to cash accounting down here, right? So what is the benefit of using the indirect method? I think the user can really see the link between the statement of cash flows, the statement of income, and the statement of financial position, right? Because these accounts are from the statement of financial position. So they can see the connection between these statements. The direct method, on the other hand, and keep in mind, they both result in the same outcome, right? So it's just showing things in a different way. The direct method really shows the cash that's being received. So it's providing information on the company's source and uses of cash. And they can really use this information to estimate or predict what might happen in the future, right? This might be, let's say they think that the business is expanding on a rate, they're going to be 5% higher next year. They can use this information and say, okay, if this was next year, I would expect the cash received from customers to be this amount now. So they can use this information with regards to how did we get our money and how did we spend our money to predict what happens in the future. So keep in mind, these are two different viewpoints of the exact same